Hi everyone and welcome to this YouTube channel. In this video, we are going to talk about reach financial freedom. Please subscribe and type subscribed in the comment section below. Understand current financial conditions and needs. The first step in achieving financial freedom is knowing your financial condition. How much is the fixed income and the amount of routine expenses each month, and whether there is a debt or not. If the obligations you have to pay each month are greater than your monthly income, then you have not yet reached the concept of financial freedom. Determine in the future whether you want to reduce the obligation that comes from debt or even increase the amount of income. By knowing your current financial conditions and needs, you will be more focused on achieving future financial goals. Do financial planning carefully. The next step is to do careful financial planning. The need to apply the right way of managing finances, determining how long a person's financial freedom can be achieved. You must be able to allocate each expense item wisely. For example, what percentage is allocated to finance daily expenses? What percentage is for savings and emergency funds? And what percentage is to pay installments, if any? Every individual's financial planning is different. That is, allocate 40% of your total income per month to finance daily expenses such as food, transportation, electricity, internet, and others. Then, allocate 30% to pay installments or debts, if any. Always try to pay debts on time so you don't get fined and have a good credit score. Next, allocate 20% to saving and setting up an emergency fund. The remaining 10% is allocated to do good activities such as charity or alms. Have sufficient savings. Having sufficient savings is very important to achieve the concept of financial freedom because these funds will be very useful in the future. You can take advantage of the auto debit feature from your bank so that it is always routine to save every month. For the amount, you can refer to the formula for setting. Allocating more than 20% every month for savings, of course, is better as long as your daily needs can be met. Set a saving goal to prepare for a more mature future, such as funding children's education costs, renovating a house, buying priority items, or other positive activities. Looking for additional income by doing business. If you have more time and energy, it never hurts to get additional income from various sources. For example, you can run a side business that doesn't interfere with your main job. There are many types of side businesses that you can run. Start with a small side business first. If your business is growing and would need additional funds as business capital, you can apply for a business capital loan from a financial service provider such as BFI Finance. A business capital loan. It does not necessarily discourage you from achieving the concept of financial freedom, as long as you can manage your business well and pay your loan installments on time. Your goal of financial freedom can still be achieved. Invest. To achieve financial freedom, you should also make investments that are tailored to your risk profile. If you are a beginner in this investment activity, try investing with low risks such as mutual funds or gold. The investment aims to develop assets either in real or visible and financial investments, so the benefits will be felt in the next few years. Pay off debt on time. Debt is okay as long as you are fully responsible for returning it according to the agreed nominal value. Having accumulated debt will certainly make life feel more difficult and far from this financial freedom terminology. So before you go into debt, set a clear goal for what you owe and adjust it to your financial condition. Paying debts on time will maintain the quality of good relations between parties. In addition, if you pay debts on time to financial institutions, it will save you from a bad credit score and pending late payment penalties. Prepare an emergency fund. It should be emphasized again that the concepts of emergency funds and savings are different. Although both are funds that are set aside from the income we receive each month, they both have different goals. Emergency funds are funds that are kept to finance uncertain conditions when and for what use. In other words, emergency funds are used to finance unforeseen conditions, such as if there is a family who becomes suddenly ill, finances daily expenses in case of termination of employment, PHK, and so on. Meanwhile, savings funds are funds that are kept to finance conditions that have been clearly defined in advance, such as savings for weddings, savings for education, savings for home renovations, and others. There is no definite formula for the size of the emergency fund. However, you can refer to the amount 6 times your monthly expenses. No less important, separate your emergency fund account from your daily savings and expense account, so you are not tempted to use the collected emergency funds. Adopt a simple lifestyle. The final step in achieving the concept of financial freedom is to adopt a simple lifestyle. Don't be influenced to live beyond your means or hedonic. In addition to quickly depleting funds, either from savings or your regular income, a hedonic lifestyle will trigger unnecessary debt. A simple lifestyle can be started by diligently saving, shopping sparingly, and avoiding debt if you can't pay it off. Determine your financial goals. It will be hard to achieve financial freedom if you don't first define what that means for you personally. Start by setting goals and thinking about what those goals require financially, says Liz Ewing, CFO at Marcus by Goldman Sachs. Goals can include short-term plans, such as going on vacation or buying a new vehicle, as well as long-term objectives like retirement. It may also be helpful for people to analyze their beliefs about money and examine their relationship with it. Know your current financial situation. Regardless of whether you're just out of college or getting ready to retire, it's essential to understand where you stand financially right now. Pull together a net worth statement, says John Pelletier, director of the Center for Financial Literacy at Champlain College in Burlington, Vermont. Understand what you owe and the interest rates that are attached to debts. Beyond adding up debt, calculate expected income and identify holes in your financial picture, such as a lack of insurance or emergency savings. Open the right accounts. There is no one single account that is right for all your money. Cash for retirement should be placed in a tax-favored 401 or IRA account, while college savings are usually best kept in a 529 plan. Those with high deductible health insurance plans can open health savings accounts to pay for medical expenses. Set up a deposit schedule. Once you have your account set up, create a system for ensuring they are fully funded. Many employers will direct deposit paychecks into multiple accounts, so you can divert a portion of your income to checking, regular savings, and your emergency fund. You can also contribute directly to your 401 through a payroll deduction. For other savings goals, you may be able to set up automatic, regular transfers from your bank account to other financial accounts. Finance experts often recommend saving 10% of your income for emergencies or other goals, and another 10% for retirement. Track your spending. If you're currently living paycheck to paycheck, setting aside money for emergency and retirement savings can seem daunting. To find out exactly how much you can save, you first need to understand how much you spend. Take a month to track where your money goes, from major bills to the couple bucks spent on coffee in the morning. Using a free app like Mint or Marcus Insights can make it easy to collect and categorize spending data. These apps can also help you pinpoint hidden expenses. Thanks for watching.